Welcome to the MUFG Global Markets FX Week Ahead podcast with Derek Halpenny, Head of Research, Global Markets EMEA and International Securities. It's Friday, 7th August 2026, and joining Derek to pose some questions on the financial market themes for the week ahead is James Roulston, Vice President, FX Institutional Sales. This podcast is only intended for professional investors in jurisdictions in which its use is permitted under applicable laws, rules, and regulations. It has been produced for information purposes only and should not be construed as investment research or advice. MUFG EMEA disclaimers and disclosures can be located on our website.
Happy Friday, Derek. Thank you very much for joining me.
Yes, same to you, James.
If possible, we've just had the payroll numbers come out. Can we just quickly run through what you took from it?
Yeah, wow. What a figure. I can remember many years ago, a figure like this would have caused absolute carnage on the trading floor. But, the front end and two-year yield in the US is down 6-7 basis points. So the reaction, you could argue, has certainly been a bit muted. Looking at the details, clearly, obviously, the NFP itself was very negative. There was a big drop in government jobs, which looks related to local government education, which could be volatile during the summer period. So maybe the markets are a little bit skeptical about that. The unemployment rate dropped. Kevin Hassett has been out talking about baby boomers retiring early. And certainly, when you look at the unemployment rate and how that was derived, over the last 2 months, there's been the labour force shrinking by 1 million and employment shrinking by 600,000. So hence the drop in the unemployment rate. But, from an inflation perspective, average hourly earnings down to 3.2%. Essentially, we're back at pre-COVID levels. And certainly, whatever you want to argue about the details and what we should question and, the reliability or unreliability of the data, most employment data certainly is pointing towards very limited risks in terms of inflation coming from the labour market. So this is definitely a plus in regard to our view that the Fed will not have to raise rates this year. And let's see what happens. I think the other point to make quickly, James, in relation to the market reaction, obviously we've got CPI next week.
Yeah.
We've got another payrolls report. We've got another CPI report in September before the FOMC meeting. So in that sense, we still have 3 more big prints before the meeting itself.
So a little bit more to digest before we actually get to the actual rate decision.
Yeah, like the probability of a hike has come down, of course. But, it's still, I think, around 35% probability of hike. And that's because we still got those 3 key data points to go before the meeting.
Makes sense. Even after what I thought was a big number change as well, it's slightly muted. So we've got time on our side to see how this plays out.
Yeah. Muted in rates and pretty muted in FX as well.
Okay, great. Going from a muted reaction to an absolutely not muted reaction when we talk about dollar yen and the intervention over the last week, there's been a lot to digest, lots of implications everywhere. Where would you like to start in trying to dissect it all?
Well, I think, we've written the FX Weekly today, which is just about to be published. I have argued, and I think it's valid to argue that it is significant that the US got involved. That's the first point. But the second point that we've been making to clients this week is that it's more significant that still the fundamentals fall into place. Now, when we look back historically, we can say, well, when joint intervention took place in the 3 clear examples, 1995, 1998, and then in 2011, it marked a turn in dollar yen. Now, that's kind of correct, but I would still argue it's more about the fundamentals than the actual intervention itself. So take, for example, 1995, dollar yen plunged below 100 and went down to 80. So it was falling sharply. And Japan was intervening, and then the US got involved in early April, 3rd of April, 5th of April. We had a bit of a bounce, but then they intervened again on the 31st of May. So there was a series of joint interventions with Japan intervening as well on its own on many occasions. And really, there was a statement made about the need for fundamentals to change. The BOJ cut rates by, I think it was 125 basis points. The Bundesbank, again, similar amount, I think 125 or 150 basis points. And then after a very slow first half of the year in 1995, an impact from rate hikes from the Fed in 1994, the US economy then started to recover, had a very strong second half of the year. So cuts in the Bundesbank and the BOJ, the US economy picking up, dollar yen rebounded, confidence returned to the US dollar, boom, we had our turn. So that was 95. 98, very interesting. Obviously, that was yen buying like we've had now. And that was on the 17th of June, the joint intervention. Dollar went back above those levels in August. And then the spreading of the Asian financial crisis to a Russian default, to a collapse in LTCM, the hedge fund in the US, prompted the Fed to, well, in hindsight, panic, slashed rates by 75 basis points between September and November. Dollar yen plunged. There you had your turn. And then in 2011, intervention, the coordinated intervention after the terrible, tragic earthquake and tsunami resulted in dollar yen moving higher. That was on the 18th of March. But in fact, dollar yen broke those levels. Japan intervened on its own 31st of October of that year. And it was the biggest single day of intervention that Japan ever conducted. And then, of course, moving forward into 2012, you had the arrival of Shinzo Abe, the sea change in economic and monetary policy, and then dollar yen turned. So, timing and fundamentals were important. And in that sense, going forward from now, obviously you need that for this joint intervention to be successful.
So we've got a significant moment that they've had this intervention, but we have to see the fundamentals that essentially are going to change for this to have a lasting effect.
Yes.
Okay.
And there are other elements, like, I would describe the US involvement on this occasion as somewhat half-hearted.
Okay.
Kind of for their own specific domestic reasons, in particular US Treasury yields. But there was no official statement released. Okay, Scott Bessent put something on X, but there was no official statement. They didn't sell dollars. They sold euro yen.
Yeah.
They didn't even tell Europe. The ECB found out the next day, last Saturday. It's probably a tiny amount. And the US described it not as intervention, but as reserves reallocation.
Yeah.
So, and then there's this talk about Japan using FEMA, the repo window, to swap US treasuries rather than selling them. Why would Japan do that? They've got $160 billion worth of cash in reserves. To use FEMA, you're charged. So again, that doesn't really make sense, but by stating it is the message from the US that, they're conscious of the implications for the US financial markets specifically.
Okay. So talking to a few people, the yen negatives that we sort of are alluding to, some of the big ones being fiscal expansion with the current, tax cuts that are coming in place potentially, BOJ independence, another one that we're looking at, then foreign direct investment and how that's working, how the Japanese investors are really looking to purchase assets abroad. So all these sort of factors do play in.
Yeah.
Are those the sort of points that you're looking at that we need to get clarification on to change this story?
Yeah, like what I would say is I definitely don't think we're going to get something like what happened in 1998.
Okay.
Where, by the way, on 3 trading days, we dropped by over 20 big figures. It was a mass liquidation of a big carry trade. While there's carry, of course, in the market, it's not as as purely focused in dollar yen. And as you alluded to, James, there are these kind of negative fundamental factors that aren't going to go away because of intervention. In particular, foreign direct investment outflows, which have been huge, and they've been trending higher pretty much since Abenomics in the early 2010s. Last year, 25 trillion yen worth of FDI outflows. And then the current account surplus is now constructed more of investment income surpluses rather than trade surpluses. Trade surpluses tended to get converted back into yen more frequently. A lot of the investment income surpluses stay in foreign currency. So that's a kind of a structural change as well. That is more yen negative. So I wouldn't expect a dramatic turn lower. But again, a very important element is the BOJ. And there were hints by both Scott Bessent saying he thinks the BOJ will do the right thing, intent, hike. Vice Finance Minister for International Affairs, Mimura, also indicating that FX would be done in conjunction, FX policy would be done in conjunction with monetary policy. So we expect a hike in September and another hike in January 2027. So if the Fed don't hike and all the pricing of hikes comes out of the US curve and the BOJ hike by more than what's currently priced into the Japanese curve, the mix of that after the joint intervention, I think is compelling enough to certainly argue that we're not going to go back up and test those highs, and that we should see dollar yen moving certainly low 150s into the maybe high 140s next year.
Okay.
So yeah, but there's a window right now where, of course, that the BOJ view that we have is not the market view, and I admit we could be wrong on that. They do tend to be overly cautious. So the fundamentals in the shorter window might not work out. Of course, payrolls does suggest it will work out, but Japan has a role to play as well, and that they need to show intent by hiking in September.
Fantastic. That's all my questions that I have on the intervention this week. Is there anything I've missed that needs to be flagged?
No, I think we've covered it all, really. Like, obviously, inflation next week will be pretty crucial, but I think even before intervention we had a bearish dollar view. So I guess the intervention maybe reinforces it, but we still need the fundamentals to play out as we expected.
Brilliant. Okay, so next week CPI. Here we come.
Indeed.
Brilliant. Thank you very much, Derek. Have a great weekend and speak to you next week.
And you, James. Thanks a lot.
Thank you for listening to this episode of the MUFG Global Markets Podcast. For more information, please contact your MUFG sales representative. If you'd like to keep up with our latest thinking, you can subscribe to the series for upcoming episodes. We look forward to welcoming you back next week for fresh insights from our global markets research team.